that indicate data of price over a specific period of time. We've talked about, oh, talk about, okay, let's talk about some stuff like leverage. I've been using leverage. I think I've already explained that to you guys. It's just you borrowing money with a collateral, you trying to use more than what you have to trade, and that is called leverage because you're borrowing money and using your money as collateral for that. And we've talked about okay, risk and reward ratio. I think this is something that you should actually take note, because definitely we are going to talk about this a lot, because we will is very important factor when it comes to trading. Risk reward ratio. Let's just put this randomly somewhere. And yes, so on this picture that you're seeing here, this is a one-on-one, this is a one-to-one risk reward ratio. Let me see, actually make sure that that's it. This is a one-to-one risk reward ratio. Means that whenever you enter a price on a certain level, you are risking this down part and you are trying to make this down part. Most of the time, people want to make at least 2-to-1 risk reward ratio. That is, if you're right, you make at least 2 times. If you're wrong, you lose just half. You lose just one. Say you're risking $500 to make $1,000. So if you're wrong, if you buy this asset right here, say you bought this asset right here and you were right, you put $500, and up here you'll be able to make at least $500 twice. If you were wrong, you lose this, and this was actually a little bit above 2 to 1 risk reward ratio. But yeah, this is very important too, and we'll talk about it more. And it's showing you right here is 2.01. But yeah, that's about it. It's just like how much you're trying to risk versus how much you're trying to make. It's not just about making money. This is something people forget a lot. People enter the market with the mindset of just trying to make money and forgetting about how much they could lose. So this is something to take note, and we'll dive a lot into it when we actually start practicing trading or and stuff like that. Okay, let's go to the next one, and we talk about position sizing. Position size is just like how much you're trying to put in a trade. Like we show you guys here. We had you guys here, the position that we took on that demo trade. How much was it? We took about we sold 7.5 BTC. We've already closed that trade. Let's look at the history. So we sold, okay, this is the other number, right? So this is the loss that we had. Okay, so this is the position. So position size is just how much you're trying to trade with at a time, how much quantity of that asset you are trying to trade at a time, given you have your risk to reward ratio set in. For instance, we made a $260 loss on this trade that we took because the price went against us a little bit. For instance, that time that you guys saw, at the time we were making about $600, right? Yes, so if we would have closed the price that time, we would have made 2 times this money. So that falls under risk reward ratio, just example of what I was showing you guys just a few minutes ago. That fall under risk reward ratio because we had this big position. This was our size to lose this. So for instance, we have 7.5 Bitcoin, and one Bitcoin is $123,000. Let me say offhand, 122,800 or something dollars. So we had 7.5 of them. That was our position, and we closed it at just a $260 loss. We closed it at just a $260 loss. Say we make money, we would have made more than that money. And because we had so many positions, we have so many Bitcoins, that's why Bitcoin went in. Excuse me, Bitcoin moved up less than $100 and we lost $260 on our side because we had more than one Bitcoin. That's just position sizing. Uh, we also have diversification, which I know probably a lot of you know this. It's just like you trying to diversify your portfolio, just like you trying to maybe trade or one or two asset. Like for instance, if you wanted to trade something like Bitcoin and decided like, okay, maybe Bitcoin was not bearish enough. Maybe Bitcoin is still bullish. You don't want to sell it. You go on and say, okay, maybe you should instead sell something like, where are we? Okay, let's use real money just so that we can see real money. All right, so let's say we see something like it, for instance, right? You say, since Bitcoin is looking too good than it, you want to diversify your portfolio and maybe sell more it, short more it, be bearish on it than Bitcoin because Bitcoin it is definitely looking bearish than Bitcoin. You want to sell more Bitcoin. You want to excuse me. You want to short more, bet more money on it than Bitcoin. This will give you the highest risk reward ratio than Bitcoin because this one is looking bad than Bitcoin. So you just put a small money on Bitcoin, but he put much more money on it because he think this is weaker than Bitcoin. That is just diversifying your portfolio or diversifying your account and stuff like that. Just some random word. Okay. Let me see what else do I need to get to you guys. I think, guys, there are so many words used in trading. There are so many words used in trading that you don't really need all this to be a good trader or to really start trading, but it's crucial to know some because once you start trading, you're going to know what it is. If somebody asks you, but if somebody don't ask you, you don't really need to be popping it out. But I think we should stop there and get some questions. We should stop there and get some questions. And how do I get back to this, man? We should stop there and get some questions and elaborate more on it because as we go more detail into this, we'll be able to, as we go more detail into this, we'll be able to do this thing. As we go more detail into these classes, we'll elaborate more on those words. A lot of words. Yes, please. I see Big Legend. What question did you have? Big Legend, unmute yourself and ask your question, please. Uh, Big Legend, can you guys hear me? Maybe yes. So he's probably not listening to me. Flavin, I think your hand is still up. Do you have some other question or it's from previous time?
No, yes, I have a question. Looking at the chart, I can see when the prices are going down, I can see when the prices are going up. My question now is how to anticipate, how to know if the prices will go up or if they will go down, because this will help you also to know if you should leave the market or if you should sell your asset. So is there any indicator, is there anything that can make you anticipate? That's my
Okay,
question.
Flavin, that was a good question, and we'll definitely come to that. That's a question for a whole big class. It's a big topic. Mind you, these are just words for you guys to know. We haven't even gotten to that part yet, but we'll get there. I'll show you guys. That's actually when you want to start reading the market. You want to start determining the direction of the market. When time comes for that, We'll tell you guys because it will be a whole class. It's not just one class on its own. That is something very crucial, not just a quick question. It's a lot of indicators, it's a lot of stuff, but I can point you just a quick direction just so that I don't get your question enough. Uh, okay, let's just head back here and I'll show you guys just one tool that we'll use for this. Okay. Hmm. Oh, oops. All right. Okay. So whenever you're trying to see that the market is trying to change a direction or determine a trend or whatever or something, it's a lot of factors. That's why people has a lot of different trades. People have a lot of different setups. Uh, there's a whole lot of charts. For instance, I think I put this here yesterday. When you see something like this, like a symmetric triangles, when the price is moving, the price has formed a high and the price has formed a low and it's moving within this range and it's not actually going above here or going significantly below here. It's just making something like this. You wait until that triangle is broken for you to determine a direction. A lot of stuffs, a lot of different things people trade, but that's just one of it. Or you caught some stuff like fair value gaps or other blocks. We'll talk a lot about that. Like for instance, you'll say this is a engulfing candle at the same time a other block. What is the other block? It's a candle that happened. Okay, this other block can appear in either a bullish or a bearish order block. A bearish order block, a bullish order block is a red candle or it's a downward candle that happened before the next candle that caused the up move. So these are some key points that I use. I use other blocks a lot. If you read some of my chart, you see, I don't know, is this chart, maybe it's on trading view. You see I'll put something like OB, that means the other block. So I trade that a lot. Like for instance, if you see, you can bet yourself that the price, since the price came down here, it sharply declined, but because of just this small order block, hold on, just because of this small order block, the price is still hanging right here. So if you want to be a bull or if you want to buy this asset, here is your time to buy. Now is your time to buy. Forget about this. I don't know where I put this. Let's take this out. If you want to be a bull, now is your time to buy. Stop below this other block, right? Because this is what caused all this move. Now price has visited it again. Where would this go up? I don't know. I'm not actually looking at the market right now. It has a lot of different key factors that you use, but that's just one of the stuff that I trade. Or you could also say a fair value gap is just a distance between three candles that cause price action to move significantly. So whenever you see price visit some areas like this, maybe this was a fair value gap. You can argue that. Maybe take this as your one candle, take this as another candle, one, two, three candle. So that is a distance. There's a distance between here and here. So it's just a distance between three candle. It's just a distance between three candle that cause the price to move significantly in that direction. So price between this candle one, two, three, between you see that between the third candle and the first candle they never met, they never happened to touch each other, or they were not close like these other candles, they were not close like these other ones, they were not close like these other ones. So most of the time market come there. So for you to determine whether the market is going to go up or not, you will have to see some of this stuff combined with other stuff. That's why I say it's a whole class on its own and combine a lot of different factors. You could also argue that there's another block here that caused this move as well. You could also say this is a breaker break. A breaker break means that a price means that it's a candle that failed to send price to that direction. Then once price finally did came above that candle, it went so much up. And you see that this break has already failed. But at the same time, you can also argue that this is a bearish order block. or we can say that this is a bearish order block. Mind you, an order block is that opposite candle, is the last of the opposite candle that cause the price to move to a different direction. Like this, when this a bullish, this a bearish order block, or you can say clear up here, this a bearish order block. This green candle right here is a bearish order block. It means that after this candle was formed, normally I told you guys yesterday that the probability for the next candle to form always that, okay, that I told you guys yesterday that the closure of a candle highly determine the formation of a next candle, but this doesn't happen all the time. But this was an order block because this candle failed to be green. Normally, when this candle, remember, I'll teach you guys. So when we get to that class, you ask more questions on that. But this candle closed up here. For a green candle, it closed up. For a red candle, it closed down. So whenever you see a closure of a candle will determine how the next candle will be. So this was a green candle and it closed above here. So normally on a normal market, traditionally, this was supposed to continue to be green, but it failed to be green and instead closed down here as a red candle, causing the price to move towards this down direction. So for instance, if you maybe want to enter a position, if you want to enter a position and you see this here leave all the way up here, this is when you should enter your position and stop above here, because if the price happen to visit this other block again, if you want to be safe, just stop here as a sweep. That's why I say this will be a class on its own. I combine a whole lot of factors here. Just right here, it has about 3 different indicators. There's a sweep. There's something that we call S&P. It means it's a swing failure pattern. Yeah, I forgot to tell you guys this. You should also take note of this. I'll use this a lot. S&P is a swing failure pattern, meaning that the price fail to push to a certain direction, or market makers push price just a little bit to take out some people and then move to an opposite direction. This happened right here. You can argue that this was a SLP because market makers push this right here, fool the buyers that this price was going to be bullish. But what happened? It make it to just come up here a little bit and then change to a different direction. So it's a whole lot of factors combined together. Is going to be a lot on its own, but yes, that's just one of the factors that he used. All right, so what else do we have on board? Let's get to some other questions, please. Yannick, I see your hands up. Please, let's get your question so that we can get a lot of questions as possible for today before this class ends.
Oh, yeah, it was a very short question. So I was going to ask about the trading with the leverage. So do these people set like, say, a limit of how much you're supposed to have in your trading account before you can maybe do all this like buy with this multiplication? Or what other conditions do they have like require you to have before you can trade using that leverage?
Please, I didn't get your few words. Sorry about that. I had some distraction.
Yeah, I was asking that when you're trading on leverage, like
Yes,
yes, are there some conditions? I know they require you to have like some collateral. Is it
yes.
like they require a certain amount of money in your account before you can trade on leverage, or they also have other conditions that you must meet in order to be on that point?
So the actual only thing needed is just the collateral. As nothing else needed. So long as you put $1 into this account, put $1 in here.
Yep.
Uh, if you put, okay, we have about 60 cents. Let's just use that 60 cent. Let's multiply this 60 cent times like 100 or something. Okay, let's multiply this times something. Okay, 100. Well, I don't know how much that give me. Let's put it to like 250 and see if this can sell us one Solana. Okay, we'll be able to say just have Solana. Oh man. Oh, okay, that was for the long side. Sorry about that. Let's do the short side. Let's confirm that. Let's say short this. And there you go. So we just open a position on Solana, this real money, mind you. So if this price just go up a teeny bit, I'm going to be wiped out of my money, out of my margin. So all about this is not no conditions at all, nothing at all. It takes just your money as collateral and the leverage that you're using. If you put $1 there, you want to multiply it by, let me see, what is the max that you can multiply this? If you want to multiply it by 300, that is fine. Totally, as you are aware of the risks involved, that is up to you.
Okay. Yeah.
So it's no other condition than just you knowing the risks, knowing fully well that if this move a teeny bit, if you
Yeah.
use so much leverage and you move a teeny bit, your money will be gone instantly. If you use small leverage, will take long for your money to be gone and will take you to minimize your loss. Like most of the time, uh, I use just about one to sometimes just five, depending on what I'm trading. If I'm trading on a swing trade, probably sometimes I just use maybe 10x or 5x. Like a trade, when I mean swing, mean that I want to hold it for a little bit, couple days and
Mm.
weeks. But if I'm using like if I'm scalping, I could use up to even just this. Like for instance, if this was a scalp and I'm using maybe a small time frame, like maybe just a minute or something, and I'm seeing that okay, what am I seeing here? Price is rejecting right here, right? I just sold. I sold at the bottom. So assuming that this is the other block, assuming this is the other block, I want to close immediately above here. I don't even know